There's been a blockbuster move in the credit card world. Capital One has just announced that they're buying Discover for $35.5 billion. We're going to talk about how that affects you. We're going to talk about why Capital One is doing that. And if that interests you, feel free to follow me for some more credit card breaking news. There are three big parts to tackle here. We're going to take them one at a time. The first is the financials. The second is Capital One. And last, but certainly not least, is how this all affects you. Starting with number one, the financials. The deal, it's called an acquisition, which is where a bigger company acquires a smaller company, but it's more like a merger. The two companies aren't really trading any cash. It's an all-stock deal, and the two companies are actually fairly similar size. Capital One is a $51.5 billion company. Discover, up until this deal, was a $30 billion company, and they're being bought for around $35.5 billion. But that's all being paid for in Capital One stock. So if you're a Discover shareholder, assume you owned all of Discover, your $30 billion worth of Discover will now be worth $35.5 billion of Capital One. But no cash is actually changing hands. And because the companies are relatively similar in size, it's actually kind of like a merger. So the big question here then is you have two of the biggest credit card companies merging together. What are the odds that regulators are going to shut this down because they don't like having too few players in any one industry? Last year, TD Bank actually had to pay a $225 million breakup fee to First Horizon when regulators shut down their deal. So it's a real concern. And it's also worth noting that when it comes to this deal, there's a breakup fee. That breakup fee is a $1.4 billion breakup fee that Capital One has to pay Discover if Discover ends up taking a deal from a different bidder. Meaning if someone else comes in, Discover's not allowed to advertise themselves to anyone else, but if someone else comes in and gives a much higher offer, or any offer that's more appetizing to the Discover shareholders, then Capital One owes Discover $1.4 billion. But in this case, unlike with the TD deal from last year and with First Horizon, if regulators break up this deal, that $1.4 billion breakup fee does not apply. So clearly, Capital One thinks there is some risk that this deal gets broken up. And we'll get into why that might be a little bit later on. So to recap, if you're a Discover shareholder, your $30 billion worth of Discover stock is going to be exchanged for $35 billion worth of Capital One stock. If you're a Capital One shareholder, we don't really know what's going to happen with Capital One. Enough about the shareholders and the finances. Let's get to the meat on this bone, which is why in the world is Capital One doing this? Discover doesn't really have any cards that compete all that much with Capital One's core businesses. The Venture Card, the Venture X, the Quicksilver. These are not cards which Discover has any real competitor for. The reason Capital One is doing this deal is not for the credit card company Discover. They're doing this deal for the network Discover. And here's the difference. A credit card issuer or a credit card company is someone like Chase, someone like US Bank, someone like Barclays. These are players who issue credit cards, but you'll notice on every credit card that you have through those issuers, there's a different network. And wherever you swipe or tap or insert the card, that network has to be accepted there. So the networks in America are Visa, MasterCard, American Express, and Discover. That's important because every time you charge something to your card, the network, so again, that's Visa, Amex, MasterCard, or Discover, the network takes a cut anywhere from 1.5% to 3.5% of the transaction, and the issuing bank, which might be Capital One or Chase, has to then pay that fee to the network before they can take anything on the interchange fee. And the interchange fee is a large portion of where different revenue comes from for these different issuers. So for example, with American Express, about 60% of their revenue comes from interchange fees, and only 40% comes from interest that they charge you on payments you haven't paid off. when it comes to Discover, it's a different story, and a lot more of their revenue comes from interest than it does interchange fees. Interchange fees are a huge expense for any of those issuers like Chase, Capital One, US Bank, Barclays. Interchange fees are a huge expense for them, whereas if you are Discover or American Express, those interchange fees are then a big profit center for you, because then you're not paying off of your top line whenever a card is swiped. You get that for free, essentially. And so what Capital One is really doing here is they're doing two things. Number one, they're increasing their profit structure, because now if Capital One can move a bunch of their cards to the Discover network, then Capital One is going to save a ton of money, which means they'll either be able to reduce fees or give you more benefits, or just keep more money for themselves. But most likely, it's going to be some combination of the three. And the second reason they'd be interested in doing that is because you've seen Amex kind of compete with Chase and offer the Capital One Venture X, which is supposed to compete with the Chase Sapphire cards. They've even been trying to compete with Amex a little bit, but Capital One hasn't really been able to go up market like Amex. And now that they don't have to pay Visa or MasterCard every time a card is swiped, there's a good chance that they'll be able to go up market and leave the subprime space that they're kind of used to. So they might be able to compete with your Amexes, because now, like Amex, they have their own network, which means they can offer more valuable rewards, they can offer lower annual fees if they need to, and they can just make their cards way more competitive as a whole. Now, so let's talk about how this impacts you as a consumer, which is what I think interests all of us the most. All right, so the first way that I think this will impact consumers is we'll see Discover cards accepted way more often than they do right now. Discover is the fourth biggest network. A lot of the times you'll see places accept Visa and Amex and even MasterCard, but they won't accept Discover. I think that's going to change now that there are so many more Discover compatible cards out there, because a lot of the Capital One cards will be moved to Discover. And on top of that, I think we'll see Capital One cards, like we touched on earlier, getting way more competitive. So those are good things. But the last and least obvious way this will impact consumers, but what might end up having the biggest impact, is the impact this ends up having on the Credit Card Competition Act, which is a bill in Congress that various lawmakers on the left and the right have brought up, but have never gotten enough momentum to actually get a vote on it. And the crux of that bill is basically forcing credit card issuers, which are your Capital Ones and your Chases, to allow more than one network on each card that they issue. So that would mean that you can't just have a Visa card, it would have to be Visa and Amex, or Visa and MasterCard, or Visa and Discover. And the reason lots of people in the credit card industry don't want that to happen is because that means that the interchange fees will then be much more competitive, and so the interchange fees will go way down. And while that at first sounds interesting to consumers, because obviously lower fees is usually better for the consumer, there have been studies where these rates have actually gone down, and the stores, the retailers where we swiped our cards, ended up just taking that extra 1.5% to 3.5% and keeping it for themselves, and costs didn't actually get lowered at all. And so what ends up happening is, instead of everything dropping by 1.5% to 3.5% in price, which is what you would hope to happen if the interchange fees are way more competitive, you end up just having an additional 1.5% to 3.5% revenue for these different stores. And they don't really share that with the consumer. And on top of it, if you play the credit card game correctly, you'll actually be able to earn way more than 1.5% to 3.5% back on your spend. So it's actually hurting you even if the savings go to the consumers, which they don't. But the impact that this merger or acquisition will have on that bill is hotly debated. No one's quite sure if it's going to be positive or negative in terms of whether it increases or it decreases its odds of passing. Some people think it's going to make credit cards less competitive, because now you have Discover and Capital One merging together. Fewer players means less competition, which means the Competition Act is more likely to pass. Whereas on the other hand, you have Discover, which wasn't really so competitive earlier because it was only Discover cards, which aren't that popular relative to your Chases and Amexes and Capital Ones. Now you're taking Discover, you're basically giving it a superpower and leveling it up to the point of Discover plus Capital One, and now that's a real competitor with Visa and MasterCard and Amex. And so that makes everything more competitive because instead of having this baby brother of Discover who's not really competitive, now he's all grown up and he can really compete with the big three, so you added another serious player. So those are just some things to watch out on. By and large, if you're a consumer, I wouldn't worry too much about this. I think the only noticeable changes you're going to see in the short term are going to be Capital One credit cards are more competitive and Discovers are going to be accepted way more often than they are now, perhaps even internationally, where Discover notably isn't accepted all that often. So if you're a consumer, overall, I think this is something that's slightly good for you, but probably doesn't matter. If you're Capital One, I think this is excellent. You're saving a ton of money and it gives you a huge competitive leg up. And if you're a financial stakeholder for any of these companies, if you're a Discover stakeholder, you're doing pretty well. If you're a Capital One stakeholder, God knows what's gonna happen. But overall, I think consumers should be generally happy about this, but it's not the end of the world. It's not the biggest news in the world. It's just a big acquisition and things like that happen pretty frequently. Follow for more credit card news and I look forward to next time.